presume that Christian. Oh, I see. Just that way and that way. Okay, cool. Thank you. Good morning, afternoon, everybody. Like other presenters, I've got sort of, 25, 30 pages of slides, which I think if we start flicking through all of those and you've got a whole afternoon ahead of you, it's not really going to be an easy day for you. So all the slides here you can get from Christian. They'll all be on the website in maybe a week or so. So I think what I'd rather do maybe is just sort of tell you a few stories about. One is about me, which is a bit embarrassing, but I'll tell you. And then some others are stories about the sort of companies I invest in and why I invest in them. And I'll give you a few guidance along the way about the way we sort of go about doing this. So the first story I'm going to tell you, I literally only decided to do this morning, but hopefully you'll bear with me. There's a gentleman in the audience who I had to apologise to this morning. And the reason I did is because I presented to this gentleman on Tuesday afternoon, and at the drinks reception that Christian very kindly organised on last night, he came up to me, shook my hand, and probably expected to carry on the conversation we'd had on Tuesday. I didn't remember who he was. And I'm embarrassed, and I'm not going to look at the gentleman now, but I didn't remember who he was. I remembered I'd met him. I remembered that we'd had a nice conversation. I remembered that we'd agreed on some things, but I couldn't remember if I'd met him in Madrid, or if I'd met him in London, or I met him in Zurich. Now that's really embarrassing when I met the gentleman 24 hours before. Okay? So that's a confession, and I hope that person has accepted my apology, and let's leave it at that, okay? Equally, there's a lot of documents on my website that I've written, long investor letters, research pieces on Netflix when we purchased Netflix, and all this sort of stuff. And those are all sort of quite nicely written pieces, and I'm proud of them. But thank God for spell check, and thank God for a fantastic assistant. Because if you read the first drafts of those, I've spelt the same word differently 3 times in a single page. So necessary or tragically or whatever else, I have this strange ability to do that. And then the final thing I would say is that if Christian had said to me, look, we've changed the format of Valuespain this year, so we would love you to come, but everything's on autocue, so you need to stand and read an autocue, I would refuse to come, because I cannot read an autocue. So I can articulate the words in my head now and communicate them to you on this microphone, but I can't read an autocue in a way that you can understand. Now, all of that shows that I'm not a fully functional human being, and there are bits of my brain that are not as they should be. I'm not going to make excuses, but I'm also dyslexic. So these things tend to happen. And if my wife was here last night when I didn't remember the gentleman in question, she'd go, oh, for God's sake, you've done it again. So she just finds this exasperating. Now the reason I tell you this is because I think I've spent a long time doing this job. I've been investing since 1987. So I joined the stock market in 1987 when I was 18 years old. I've seen lots of cycles come and go. I've looked at return on capital employed, I've looked at moats, I've looked at growth, I've looked at value, I've looked at, you name it, I've looked at it. I've looked at negative working capital, everything. But the bit that it really comes down to is edge. It comes down to how do you interpret events differently to other people's events? Okay? So I've just sort of explained to you my downfalls, if you like. And I've said there's a dyslexic thing, whatever, okay? But what you might not know is dyslexics are very good at 3D image generation. So about 80% of all dyslexics, about 80% of all architects are dyslexic. Now, the architect industry doesn't set out to recruit dyslexics, but dyslexics can take that glass in there, and they can, not all dyslexics, those that see 3D images, can rotate that glass in their mind and look at it in 3 dimensions. I definitely cannot do that, okay? But some can. So if you're sitting, if Christian was sitting wherever he is, an architect's exam, and if the guy he's sitting the architect's exam next to can rotate a 3D image in front of him, Christian, sadly, is not going to come top of the exam. Okay, so that's why so many architects are dyslexic, because they have this ability to do this strange thing that I can't do. The only thing I can do is pattern recognition. So I can't spell, I can't remember what people's names and faces are, I can't read an autocue, but I can do pattern recognition. And so what I've worked out in the last few years is that's what I have to do. I find places where I see patterns, and obviously I didn't just set out one day to go, well, I read it in a book, I'll try pattern recognition. I obviously have had experiences in pattern recognition, and they have emboldened me to go, I've seen this business model before, or I've seen this activity of a chief executive getting slammed by the stock market before. Okay, so I think working out who you are and what type of investment you can do and what you are good at and bad at is actually quite a large percent of this job, and I don't think it gets talked about enough. So let's just do a couple of things. There's the track record of the strategy. I started a fund in 2011, converted it to UCITS in 2021. Holland Advisors is my business. There are 3 full-time employees and 6 total employees. We only run one fund. It's all we do. We only ever want to run one fund. Okay? There's all sorts of drawbacks to that, but there's a few positives to that, rightly or wrongly. That's the relative track record for the last 3 or 4 years since we've been a UCITS fund. We're up roughly 50. The IA sector's up roughly 25. I think you can take about 5% off of both of those numbers. Maybe we're -5 and it's -3 since March time. Don't know. There's performance by year. There's the top holdings we've got. We can come back to talk about all those things later, maybe. They're outputs as far as I'm concerned. It would be more interesting maybe to go through with you some inputs and then at some stage, as you hopefully will be looking forward to, we'll get on to talk about some company examples and specifically whys. So what am I trying to do and why? I'm trying to get up the compounding curve. And with respect to the speakers that have gone before, I don't give 2 hoots whether that happens by me overpaying, if that's what you think it is for a growth company, or finding fantastic compounding because I built a workout and that workout did really well for us in a short period of time. All I'm trying to do is get up the compounding curve in the best risk-adjusted way that I can. I'm sure many of you know this sort of charts, you don't need me to tell you, but if you compound at 15% for 25 years, you've roughly multiplied your capital 16 times. And if you compound at 5% for 20 years, you've roughly multiplied your capital 3 times. Now, those numbers sort of might seem a bit outlandish in terms of their outcomes. But the average stock market probably goes up 7 to 10%. The average investor in the stock market makes more like 5. And the reason and I don't mean the average investor in this room, I mean the average investor in toto. And the reason they make more like 5 is because average investors are not very good at buying at bottoms and selling at tops. They're very good at doing the opposite because of the way the sentiment works. And also the average investor pays fees. So that 7% might become 6 and then it might become 5 with a bit of not great market timing. So the average investor probably does make 2.6 times their money in 20 years. Whereas if we go to a Nick Sleep or we go to a Warren Buffett or someone of that nature, or we look at fantastic businesses like Berkshire Hathaway, like Costco, like Amazon, well, they're in the 15 to 20% camp. Okay? So this is a better outcome is possible. But it's just a question of being sort of wired and determined to try and find that. I'm not going to go through some of this because this is sort of our process that we don't perhaps need to go through in great detail for this audience. What I'm going to talk to you about is just sort of 3 basic building blocks of how I go about running, say, 75% of our money, of the money in the fund. And then I'm going to quickly get on to the building blocks of how we run the other 25%. Because it's the other 25% I want to talk about, and that's what we're going to use WISE as an example for. So I'm going to rush through these next 3 slides, but in an investor presentation, I spend a lot of time on them because they are my whole process and how I go about it. So earlier on, I talked about pattern recognition. This is pattern recognition in business models, okay? Many of you will have heard the expression of moats, and you'll have been to the Berkshire AGM and all the rest of it. If you haven't read 7 Powers, I strongly suggest you read 7 Powers. It's a bit management consultancy, but it's very, very good at dissecting moats into a more granular level. So what I've written at the bottom is that we find most opportunity in sustainable competitive advantages least understood by other investors. Okay? So this again comes back to edge. I'm not just saying, well, Coca-Cola's a great business, so I'll go and buy Coca-Cola, or ABC Engineering's a poor business, but it's cheap, so I'll buy that. That's neither of those is a good enough outcome to get up the compounding curve. I want SCA models that the stock market doesn't fully understand. So let's a quick examples of that. So in the branding category, so you've got 7 categories there. I'm just going to mention a couple. In the branding category, Coke is obviously one example, but so LVMH is another example. But there isn't, let alone in this room, there isn't an investor in the entire investing universe that doesn't know that LVMH or Coke isn't a great company. So no shit, Sherlock, they're fully priced. Okay? So and that works for most businesses with most moats most of the time. Okay? But what about counter-positioning? Some people don't even know what counter-positioning is. So counter-positioning is what Ryanair did 25 years ago when Ryanair said, you can go and fly with Lufthansa or British Airways if you like, and the planes will probably run on time, and you might get a glass of fizzy wine, and you get a slightly wider seat, and it'll be nice, and it'll feel a bit leathery, but it's going to cost you £265 to fly London to Frankfurt. Fly with me if you like, and we may or may not be rude to you, but the plane will land on time, and it'll cost you €35. That's counter-positioning. Counter-positioning is also Netflix going sort of public with its view about how to rent a DVD or a video and says, don't go to Blockbuster on the street corner. Why waste your money doing that? Just get it from us online and we'll post it to you. Oh, and now we'll download it to you with streaming. That is counter-positioning. Okay? So the stock market does understand a lot of competitive advantage businesses, but it doesn't understand all of them. So it didn't really understand what Netflix was doing all the way through. It didn't really understand what Ryanair was doing. And one of the business models that we own the most of in the fund is the scale economic shared business model, so Nick Sleep's favourite business model. And the stock market does understand that Amazon, and I'm sure everyone else in this room knows that Amazon and Costco are scale economy shared businesses. So Amazon and Costco are mostly fully priced most of the time. Ryanair is also a scale economy shared business model. JD Wetherspoon is also a scale economy shared business model in the pubs and bar sectors. Jet2, which I own in the fund, which makes a return on equity of 25% that is on a P of 7, is also a scale economy shared business model. But it's not priced like it. Wise PLC, which we're going to talk about in a minute, is also a scale economy shared business model. But when it, this time last year, stood up in front of investors and said, we made a lot more money than we thought we were going to make when we floated on the stock market, so we're going to reinvest half of our profits back in the customer offering, I was like, fantastic. That's exactly what Amazon would have done 20 years ago. Share price went down 30% in 3 months. So that tells me the stock market doesn't understand that Wise has a powerful business model. So this is what I want to do. I want to find powerful business models when the stock market, not that the stock market agrees with, but that the stock market disagrees with. So that's building block 1. Building block 2 is owner managers. I'm absolutely obsessed with owner managers. They're all quirky and weird and dyslexic and odd and unpredictable, a bit like I am some of the time. And some of the time the stock market worships these people, and some of the time the stock market really, really hates these people. And at those moments in time is my sweet spot. That's when I get very excited, when what I think is a powerful business model run by an inspirational and visionary leader suddenly is marked on sale. Okay? Now that happened to me a lot with Frasers, which is Mike Ashley's on the top right-hand corner here. Used to be called Sports Direct, rebranded itself as Frasers, and I was just talking with a gentleman for coffee just now, and just saying that in the UK is uniquely brilliant at absolutely hating anybody that creates jobs and wealth. I mean, I can't not swear, but we are just brilliant at it. So the fact that Mike Ashley and Tim Martin is not on here that runs Wetherspoons, the fact that they've created thousands and thousands of jobs and have saved people millions and millions of pounds by being able to buy their goods and services at cheap prices, and they pay loads of tax, and they've helped their industry sort of change, nobody cares. Just you campaigned for Brexit, so we hate you, or you had a bet with an investment banker once, so we hate you. But it is that investor mentality that leads to mispricing. It doesn't lead to mispricing all the time, but it leads to mispricing some of the time. The most compelling example, however, and later in the presentation, I won't go through these slides today, but they're there if you want to look, is some work on Meta. And we wrote some research on Meta. It's all on the website. I was admitting to some gentlemen the other day, I don't have a single Excel spreadsheet on Meta, but we had 4% of our fund in Meta at under $150, but don't have a single Excel spreadsheet. Now that sounds quite negligent, but there also isn't a book on Meta I haven't read. There isn't a podcast that Zuckerberg or anyone else has done I haven't listened to. I've never had an Instagram account. I've never had a Facebook account, but I do understand the Meta business model. Why did we end up having quite a good position in Meta at a low price? It was purely and simply we took a bet against the market psychology. And this piece that we wrote around that time is on the website. I just thought the stock market was doing to Mark Zuckerberg exactly what it did to Mike Ashley. It decided that he was wrong and they were right. And during the 2-year period or 18-month period, either side of the bottom of the Meta share price, $2 trillion worth of Meta changed hands with, I don't know, some algorithm fund one side and some momentum fund the other side. But none of it made any sense. The business wasn't in serious decline. All that was happening was the chief executive was entering a deep and unpredictable investment phase. He thought the metaverse was the next best thing. I had absolutely no idea. I just thought that one way or the other, this will resolve itself. And either he'll be right, and the metaverse is the next great thing, and we'll all have to sort of lick our wounds and admire him, or he's a rational human being that built the business from scratch, who is losing more money than all the rest of us when the share price goes down. So he will also be rational, and he will start to curtail the money he's spent, and so on. So this isn't about spreadsheets and modeling and all the rest of it. It's about understanding when a pattern is different or you've seen it before. That's either in a business model or in the behavior of some of those owner managers and the behavior of how the stock market interacts with them. So what I'm really trying to do, building block 3, is basically buy great companies when the rest of the stock market hates them. I have never yet been to a presentation where I haven't used this slide, and I've never yet been to a presentation where everyone sitting across the table from me doesn't go, oh yeah, I do that. That's what I do. Yeah, I buy great businesses when everyone hates them. Utter bullshit. I used to write investment research for 20 years, so I provided that to, I won't mention the names, but big organizations who have very senior fund managers, and I've got a lot of friends at those organizations, and they are some very, very brilliant investors. But I have written research pieces on things like JP Morgan at $50 5 years ago, sat across the table from someone who just could not compute coming out of the credit crunch that JP Morgan could be a company they could consider, or Meta at $200 or whatever, or Frasers. So people find it psychologically incredibly difficult to buy a business that's gone down a lot, that's run by an unpredictable individual who won't talk to them, who won't go into investor relations with them. Mike actually hasn't met an investor for about 5 years. And that's what gives some of the mispricing. And you have to work out which bits of the jigsaw puzzle you need before you go, oh, I can see the picture, I'm buying the shares. It was Anthony Bolton, who was a brilliant investor based in the UK for many years. It was him that basically said, if the last piece of the jigsaw is in place, the opportunity's gone. And that's what I'm trying to do. I'm trying to use the pattern recognition of business models. So I want these companies that we invest in to be good companies. I don't want to buy what some in this room might think are value opportunities if I don't think the quality of the business is enough. But I do want to buy a quality business when the stock market says to me there's something wrong with it, and I don't agree with that assessment. Okay, I want to talk about why. So let's just mention the other 25% of the portfolio. So 75% of the portfolio is good compounding businesses, run by owner managers, cheap and depressed when I bought them. And after that, there's a bit of a buy and hold, and we just see how it works out. But let's leave that for now. The other 25% of the portfolio, which has grown in the recent years, has been what I've called my search for supernatural compounders. I'm a big Nick Sleep fan, but I'm also a value investor. So I own, stocks on P's of 8 and 10 and 12 and all the rest of it. But I admire Nick Sleep, and Nick Sleep only owned 3 stocks. He owned Amazon, Costco, and Berkshire Hathaway. Okay? Just let that sink in for a bit. Hasn't traded those stocks for 20 years. He owns 3 stocks. The aggregate compound of those 3 stocks is 20% for the last 20 years. Way above my compounding 15% chart. The problem with buying pattern recognition and buying entrepreneurs when the stock market hates them is I would never have got a chance to buy those 3 companies. So I would never have bought Amazon, Costco, or Berkshire Hathaway because they were never really on sale. Now, I did buy Amazon 2 years ago when it got depressed, but that's relatively late in its life, okay? So what I've done is a study, and this piece of research is on the website. You can look at that. So that's it's about 3 or 4 page piece of research. And that was a study basically of, well, are there 1 or 2 special companies in the world that you should change the rules for and pay up for? I won't go through this in detail, but there's a guy called Besson Binder who did a stock market study of the last 30 years. And basically he said, he concluded the following. He found that the top 2.4% of all firms, of firms in the stock market, i.e. 1,500 out of 64,000 quoted globally, gave you the entire stock market return from 1990 to 2020. Now, of course, everyone's going to say it's the Mag 7 and it's, you know, it's only at this point in time and da-da-da. Yeah, but those are the facts, okay? The best 0.25% of firms accounted for half of the stock market creation, of all stock market wealth creation in the world. That's 160 companies out of 64,000 companies. So we can spend a lot of time as value investors saying, well, you know, Nvidia's a bubble and there's this and there's that. I think it sort of misses the point. The point is you want to own tomorrow's Mag 7s. You want to try and find a way in your portfolio of having tomorrow's Mag 7s. Okay. You can work out for yourself how I use this chart. Basically, it's me saying we want these companies at the very end of the extreme. Okay, we want to find that 0.15%. And if we find those, we could get some very, very exciting returns from that part of the portfolio. So what are the characteristics supernatural compounders have got? Well, supernatural compounders have a visionary founder, a founder that rethinks their industry, solving a hard problem. He gives the customer a compelling offering. He's low unit cost driven and customer obsessed, has a huge runway of growth ahead, and makes good or great returns on invested capital. The crucial financial aspect of these businesses is they have to have an ability to redeploy almost all their profits back in the business, retain capital at equally high rates. Amazon, Berkshire, and Costco all did that. Okay? So here's a few words on Wise. Wise said you need a Buffett said you need a genuine desire day in, day out to delight the customer. I've seen a lot of businesses, but I've never seen one that focused on delighting the customer that didn't succeed. Okay? So that's crucial. Your probability of success is high. Here's the founder of Wise PLC. The biggest driver of new customers is word of mouth recommendations. And the biggest driver of recommendations is the fact that we have such cheaper and more transparent than other banks or anything else that's available. Here's scale economy shared happening in Wise. That's their chart from their website, and there's a quote there which you can read in your own time. And here's the traits that I see in Wise as a supernatural compounder. Okay? It is solving a customer problem. You know, the cost of Forex in the banks is prohibitive, particularly for individuals or for SMEs, and customers are saving 2% pretty much with every transaction they use with Wise. It's also reinvesting its profits to reduce customer pricing further. I mentioned this, that the share price fell when they did that. And it's also building its own in-house clearing network, competing with the existing networks that produce. It's reinvesting massively back in itself for higher ROE rates, and it's got a massive, long runway of growth that it can grow into. The last thing I'll say, and we'll open it up for questions, is some of you might have read Good to Great by Jim Collins. In it, he talks about 3 core traits that great growth businesses require. And these are the 4 traits. Preserve a core ideology, have big, hairy, audacious goals, try new things, and do constant innovation in new products and services. That is what I believe Wise is doing. And I've got other stocks in the portfolio, the other I'll mention, that are similar to this, and that company's New Holdings in Brazil. So Wise and New Holdings, I think, are both supernatural compounders, and their businesses I've paid up for 20-odd times earnings which at a value conference I'm sure makes me sort of Satan in disguise. Anyway, let's stop there and take any questions you've got. I have no idea where we are on time.
Thank you. Do you have any questions?
One thing came to mind while you were talking that through, Andrew, was the list of companies that you would put as successful serial acquirers. And have you actually got a list of those and follow those? And do you think those deserve a sort of almost a permanent weight in a portfolio?
Great question. So for the essence of time in the format that we're in, I've just talked about an organic supernatural compounder, which is wise. So it's reinvesting in the core business. And New Holdings is exactly the same. If you read the piece that I mentioned, I talk about two different types of businesses, or potentially three, but two main ones. One is that organic supernatural compounder. The other is a conglomerate, so i.e. like a Berkshire Hathaway type vehicle. So you can take capital made in one division and redeploy it in another. And if you're incredibly astute, you can achieve the same outcome as you can in an organically growing business. And someone like Bolloré or maybe Baglari, in my view, might qualify for that. Berkshire definitely qualifies, and they might qualify. The third category, as you highlight, is the serial acquirers. I looked at some of the serial acquirers in the Scandies. They're clearly very impressive. I went to the Serial Acquirers Conference last year, which I thought was brilliant. I haven't bought any of those businesses. Do I admire Constellation Software from afar? Yes. I do own a business called Kelly Partners in the fund. So I bought 2% in Kelly Partners, which is worth about 3% today. I would have bought more of it, but it's quite a small cap stock. It's maybe 400 million market cap, but was much, much smaller than that when I bought it. So yeah, I think they do qualify, but you need... My view on acquisitions maybe 5 years ago was I didn't want acquisitive businesses. So most of my companies like Jet2, the tangible book value and the book value look exactly the same. But I've obviously come across those serial acquired businesses and realized that there is a small exception of people who are good at this. So I did own Melrose in the UK because they are brilliant at executing on this. And I do own Kelly. So yes, theoretically you're right, but I just think we need to be really, really careful on who we give our money to, believing they can redeploy it in that way.
Anybody else?
Whatever, anywhere. Well, you decide. Some there and there's some there.
Thank you. It's a great presentation. Could you maybe share some ideas about how you source these supernatural compounders? So what's the due diligence process? How do you find these in the first place? What do you search for in the first place?
The lady, I don't know if she's still in the audience or not, but the lady that spoke from T Row was here earlier on. Where is she? I can't see where she is. Anyway, hi there. When she stood up earlier on, she said I had a team of 100 analysts. Well, T Row used to be a research client of mine a very long time ago, so a great organisation. But when she said we have 100 research analysts, I sort of slightly shrunk in my chair because there's basically me and one other guy helping me, and that's it. So yeah, we don't have huge resource. We don't take anyone else's research. We don't read anyone else's research. My entire investment approach to ideas is what also looks like this. So I know exactly the type of company I'm looking for, and now I've split it into sort of two different types, as I've hopefully shown you today. New Holdings I had never looked at. So New Holdings is the other company, which is just... So this is New Bank. It's called New Holdings. It operates in Brazil as New Bank. I saw that Buffett had bought it, or Berkshire had bought it about 2 or 3 years ago. Never looked at it. And then I was literally one Christmas, I came across a podcast, and I listened to the podcast, and 20 minutes into the podcast, I thought, oh, wow, this could be really powerful. It's just because their customer, very quickly, I learned they're customer obsessed, lowest unit cost, huge disruptor status, massive net promoter scores, better financial model than the rest of the industry. And that's, I learned all that in the first 40 minutes. But then clearly you spend a lot of time. And being self-employed, I can then decide how I spend my time. So I just don't do anything else for 2 weeks. And I just study New Bank for 2 weeks. And maybe it's 2 weeks, maybe it's 2 months. But it's enough to get to a level of confidence. So that doesn't mean I'm still not terrified by how big some people's research departments are. mostly at the back.
Yeah,
I think.
hi. Over here.
Hi.
Thank you for the very insightful presentation. I wanted to touch on WISE. How comfortable are you that the WISE Forex advantage is a sustainable one? Because what I'm seeing from my perspective, I'm seeing a lot of those very similar fintechs like mushrooms coming out. In fact, I came from Singapore and I'm using another startup which was set up by another bank, Standard Chartered.
Yeah.
And I'm using a Trust a credit card that gives me exactly the same rates that you would get on Google. So what makes WISE competitive advantage sustainable? And I think it's a bit different in my view, to Amazon, where doing that last mile delivery, etc.
Yeah.
It's it's a lot more expensive compared to starting up a fintech.
Agreed. I don't like making the Amazon analogy. I only do it because we've only got 20 minutes, and you've got to sort of get people to think about businesses quickly. I don't know for certain that WISE is going to be sort of the all-powerful winner in foreign exchange. Okay. I do know that of the companies that we come across at this end of the world, so it'd be Revolut or others, WISE is the only one that seems to be absolutely laser focused on unit cost, as in it is focused on wanting to get its cost base as low as possible so that it can pass on as much of that lowest unit cost to the customer base. So if I look at someone like Wise or Revolut, and then some of the other competitors use Wise's backhaul, okay, and Revolut is sort of wanting to be all things in digital bank, but it's not just focused on a narrow sphere and saying we're going to build the network, we're going to build the rails, and we're going to get as cheap as we possibly can. So I don't know that Wise wins, but the reason I showed you that quote from Buffett at the beginning, a lot of people know I own Wise, so I get a lot of calls about Wise from investors or from other analysts, and the calls are always the same. The calls are always, my wife uses Wise for her business. It's fantastic. She saves her a fortune. But why do you own the stock? And I sort of feel I've got a decision to make. I can either wait for the last piece of the jigsaw to say, it's definitively the winner, I'm going to buy the stock. Or I can take a bet that says, this has all the makings of the type of business that comes out on top because it's so consumer focused, it's so unit cost focused. And really importantly for me, I think what happened last year was a lot of other banks are now using the Wise network. So people don't understand. They see Wise as a card and Revolut as a card, and they know Revolut more than Wise. Revolut has no backhaul system. Wise has built its own backhaul system, and Standard Chartered and Morgan Stanley last year were the last of quite a long line of banks that said, we're going to use your system to do our foreign exchange. So I don't know, but it's just a hunch. But I want Revolut to come to the market because I want to read Revolut's accounts and listen to them talk so I know exactly how good they're going to be. And I think what will happen with Wise is either you'll see it be constantly 6 or 7% of my portfolio as I keep re-adding to it as the fund grows, or maybe the data will come out and I'll get a bit less conviction and it might just sort of drift down a bit in my portfolio. I think we have to evolve as the news evolves.
Thank you. We are running a bit late of time, so but Andrew will be around for lunch and everything, so you can ask him directly. Okay?
Thank you so much.
Thank you so much.